Equity settled SAR. What is equity settled SAR? When stock appreciation rights are given to the employee, they are whatever appreciation is found on the vesting date, shares are issued at FMB, and therefore they will thereafter hold shares, and they will be entitled to capital gains on sale of shares because there's nothing left to be taxed under the salaries. Similarly, sweat equity shares also um, taxed at an FMV minus the price or no price. So that is the difference, which is taxed as a uh, probably sometimes salary, or it is a capital gains if they are not employee and how they are associated with the company. Now, from the perspective of the employer, how the Indian tax jurisprudence have treated such cost, and by and large, most of the courts are in consensus that these are the genuine costs incurred by the companies for the purpose of employment, and therefore they are the expenditure spent exclusively for the purpose of the businesses and allowed under section 37(1) if debited to the profit loss account. If part of the cost is not debited to the profit loss account because it is creating some assets, particularly in case of sweat equity, then in those cases, to that extent, there's a capitalization in the asset built up side, the expenses will not be allowed, but depreciation may be allowed on the capital expenditure appearing in the balance sheet side. Now we come to the special issues, then the normal issues which are found in section 16 and the chargeability provisions. Now, a special issue arises when trusts are created in India. Such trusts are normally set up by the company, and this trust has a definitive number of people qualified to be the beneficiaries, and the extent of beneficial right have been not specified in numbers or value, but a formula-based benefit is given to them, and therefore they are not taxed at maximum marginal rate, but are taxed as a normal trust and normal tax, which is the tax rates of the AOP or the individuals applicable to the trust. Now, these route of settlement of shares by the company or the promoter is not found favor with the taxpayers because of the presence of section 47(3), which says that such transfer of shares by the company or issue of shares by the company will not be considered as an exempt transfer, but it will be treated as transfer of shares from a company to the trust, and therefore subject matter of capital gains under section 45. Also, section 48 provides that the full value of the shares on the date of settlement of the trust, full fair market value of the, will be treated as the consideration deemed to have been received by the company or a transferor, and therefore it will be taxed as capital gains under section 48. And therefore, most of the trusts are incorporated with the scheme of buying the shares with the help of borrowed fund by this trust, and then borrowed funds have been repaid from time to time, either by the contribution from the employees or by some other means of income which are derived from these shares. So this is about the special issue of implementation of C through trust. Some more issue arises so far as transfer of these shares are concerned. If the promoters have transferred these shares, you could probably attract the provisions of 56 to 10 as the revenue may think that is a gift by the promoter to this trust. Although there is a presence of 47(3) proviso and proviso 6 to section 48 indicates that such issues cannot be considered in 56 to 10. It should be treated as for the purpose of capital gains, but then controversy still remains in this area. Now let us look at what is the, now next 10 slides which I'm going to discuss is not the correct law, but how courts have interpreted this law for last many years. Once they have considered the ESOP has been received in India, but the Indian company has issued the shares and the foreign employee has received the shares in India. Sometimes they say that it is allowed by the Indian employer company on behalf of the foreign employer, because the shares are issued by the Indian company who is not an employer, but the employee is serving the foreign employer. And in those cases, the courts have said that this is the payment of salaries or salary paid or allowed on behalf of the employer, as referred in section 15B of the Income Tax Act. And in some cases, alternate C, in some cases, it is said that there is no employer-employee relationship. So if the shares are issued by the parent or a subsidiary of a company where the employee is working, then it is income from other sources because there is no employer-employee relationship. So these are the various issues on which the courts have ruled differently, inviting lots of litigation in this area. So let us look at the kind of a litigation. Before we go to the litigation, let us understand what is the provisions of the law. As you all know, section 5.1 and 5.2 is a charging section, not charging section, providing the scope of the total income for residents and the non-residents. We are currently in discussing this litigation concerned with the parent company in India, and there is a foreign company outside India, and the shares are issued by the Indian company, and the employees are working with the subsidiary outside India. So that means it's an outbound deputation, which is what we are discussing with the help of this 8 or 10 slides. And then we come to the inbound deputation. So the most of the litigation on both the sides are on a different footing itself. When we come to the inbound type of situation, the litigation is completely different as compared to the outbound litigation. In case of the outbound litigation, in most of the cases, the Indian have been deputed abroad on the subsidiary of a subsidiary located in the foreign country, and they are receiving the employee stock option of a company in India, because parent company's shares are allotted to the employee of the subsidiary company. And therefore, the question was arose in various occasions whether the shares are issued by Indian company, and therefore remuneration is paid by the Indian company, and therefore the remuneration is received in India, and therefore it could be an employment income or it could be an income from other sources, because the employee of a foreign subsidiary is not an employee of an Indian company. Now look at the main provisions of the law which is concerned about charging the salaries and therefore employee stock options. Friends, I may go a little bit of basics, but you will understand at the end of the discussion that how it is important, and sometimes it may work as a refreshing memory of the law as it stands. That the provisions of section 5 and 5.2 are, we normally and generally say that it is a charging provision, but if you minutely look at this provision, subject to the provisions of this act, the total income of any previous year in case of a resident SSC includes from whatever sources the following income, right? So it talks about total income, not the chargeable income, because total income will then be considered for the purpose of the other provisions of the law, which will decide what is to be charged. And also, if you see that the limbs A and B in case of A and B in case of 5.2 and A, B, and C in 5.1, they are separated by the conditions of or. This or this or this. The income received or deemed to have been received, or income accrues or arises in India, or income deemed to accrue or arise outside India. So, and in cases of non-resident, income received or is deemed to be received in India, accrues or arise or is deemed to accrue or arise in India. So therefore, both these two limbs of 5.2 is separated by or, and the three limbs of 5.1 is also separated by or. That means the law itself says that the overlapping between these three limbs and these two limbs is possible. So therefore, to remove that overlapping, we need to go to the charging provisions of section 15 for the purpose of taxing the particular item of the income. This is what I wanted to suggest. And therefore, and then how section 15 appears and how section 9.1 appears, because we are considering the non-resident employee because they are working outside India. 9.1 says, the following income shall be deemed to accrue as in India, income derived from an income, and the relevant section is 9.1.2, income which falls under the head salaries if it is earned in India. So if the salary is not earned in India, it is not taxable in India, and therefore ESOP is not earned in India, not taxable in India. And it says that services rendered in India means where the services is performed. And then we go to section 15 for charging the particular income in a particular fashion. Section 15 says any salary due from an employer and any salary paid or allowed. So the wording which are used in section 5.2, section 9.1.2 and section 15 ABC are at variance, but if you use it logistically and with an understanding of the hierarchy, that the 5.1 gives a scope of total income, 9.1 gives you deemed to accrual as in India, and section 15 says what is chargeable to tax in India. What is chargeable to tax in India? If 9.1.2 is not incorporated in section 15, then it will not be taxed in India. That's what the understanding is. Now look at the controversy. The number of cases have considered that when the ESOP is received in India, income is taxable in India because salary is received in India, so it is due in India because Indian company has issued stock option to a concerned foreign non-resident employee, and hence 5.2a read with 15a, it will be taxable on a receipt basis. Some other cases which have been come up before the courts are based on, again, same receipt basis, 5.2a read with 15b. 15b says salary paid or allowed. 15a says salary due. So when an income is received in the form of issue of shares by an Indian company, courts have conveniently used both the limb A and B of section 15 to tax the foreign employee, non-resident employee in India. How they were able to do is really a question of curiosity, which we'll come to a little later, that how it could be done and what was a miss in certain aspects, probably that was not argued before the court, or it was argued but not appreciated by the court. So this is 15b. Now, coming to the course of correction and the understanding of the law. The number of authorities, including the Supreme Court, have held that whether employer or no employer, if services are rendered, sorry, I'm missing something. My God. Sorry, I'm sorry. Just wait for a minute. Yes, sorry. Um, Considering the decision of Supreme Court in Justice Devaki Nandan Agarwal and other jurisprudence, it has been set out very clearly that whether employer-employee relationship is existing or not, if you are providing services, then such services will always fall in income from salaries and it cannot be treated as income from other sources. So that is number one. Number two is, if income is received in India, let's say for the time being, we assume that income is received in India and therefore it is taxable in India, then the treaties of India, particularly Article 15 in the of the OECD model or Article 16 with the India-US treaty, says that in case of a non-resident, the India has a right to tax only if the performance of the services in India exceeds 183 days or more. So in such cases, even if the taxes are levied based on 5 to A read with 15A or B, such income could be considered for the purpose of tax treaty and we can come out of the tax net in such manner. Also, when income is considered as taxable in India on a receipt basis because it was directly received in India or shares are issued in India. In one of the case of shipping corporation, the salaries was directly credited to the account of non-resident in India in the NRE account. It was held that even such receipts cannot be considered for the purpose of taxes, even if directly received. So in this case, even if it is applied rightly or wrongly, a receipt is in India, it can't be taxed under the tax treaty because tax treaty clearly provides that the employment must be exercised in India in order to tax it in the source country. India is a source if you assume. Then other proposition was income from other sources. There also, the Article 21 or 23 of the respective treaty would say that the right to tax the income from other sources will always be with the resident state if income does not arise in India. Where the payer is located in India, if the proper classification is salary income, payer is located in India, it cannot be said that source of income is in India, or it cannot be said that income arose in India. And in those premises, probably you will come out of the clutches of the proposition that it is income from other sources. The next issue which arises out of this is, if you are a company in a foreign jurisdiction which has no treaty with India, then we have to argue vehemently what is provided in the law, that the scope of total income is not the sacrosanct test for the purpose of treating the employee stock option plan and particularly income from salaries. Now, let us therefore go to the very, very fundamental basics, how one can argue that receipt base will never apply. Yes. If you see, this is the provision of the law. I'm just repeating it, that subject to other provisions of the Act, total income of any previous year. See, this is saying you total income. What is the definition of total income? It says income computed in accordance with the provisions of the law. That means go to section 14 and go to the independent heads of income and find out what is chargeable to tax in the heads of income. It doesn't say that a total income is taxable. It says this is the scope of income which you must consider in case of a resident and non-resident. Now, therefore, that brings us to the income. Section 5.1. Again, it says includes all income from whatever sources derived, received, accrues, accrues or arise outside India. Now look at the explanation 2, which is very, very vital in considering and arriving at some complete and thought which has no debate, or which has no controversial element into it, and which says income which has been included on the basis of received or deemed to have, that is received or deemed to have been received by him in India, included on the basis of accrual arises, shall not again be included on the basis that it is received or deemed to be received by him in India. So this is explanation 2, section 5. So total scope of income is subject to the other provisions of the Act, which is section 15 in our case. And it further says that the scope of income, if it is accrual or arise, then it cannot be included in the basis of the received or deemed to have been received by him in India. Therefore, the law tells us the sequence. What the law says is the accrual and arising is the prior to the receipt of the income in India. And therefore, and thereafter, if you go to section 912, it says income deemed to have accrued arisen in India because the employment is exercised in India. If the employment is not exercised in India, income have not accrued or arisen in India. If income has not accrued or arisen in India, it cannot be included on the basis of receipt because it is never chargeable to tax in India, as per the section 5(2)(a) read with 9(2), read with section 15 of the Income Tax Act. So this is what 9(1) says, and this is what 15 says. That means what the 15 says, any salary which is due. What is due in the case of non-resident? As referred in section 912. Because what the 912 says, income which falls under the head salaries. If you see the third line, the following income deemed to accrue in India 91, and subsection 2, 91 Roman 2 says income which falls under the head salaries. And therefore, this is the income which is exercised outside India, which must fall in salary due. If it doesn't fall, section 15 fails. So therefore, these are the plethora of decision which supports us with a sequence that wherever the payer is located, the source of income has no relevance with where the payer is located. And it says income would arise only when the source is located. And if it does not accrue or arise, then only you go to deemed to accrue or arise. And when it is deemed to accrue or arise, then only allowed or paid or received or deemed to be received will come in sequence. Some of the issues like overriding provisions of section 15/5(2) has been enshrined in 233 ITR 158 by Kolkata High Court. They say that the charging provision will always override section 5(2), which is specific and narrowing down the scope of total income which is incorporated in section 5(2). Again, Avtar Singh Wadhwan's case says that the payer's location has no relevance in ascertaining the source of income. There's a typo, ascertaining the source of income or where the income has accrued. Salary accrues where services are rendered. This has been held in Utanka Roy's case, followed from Prahlad Vijendra's case. Again, Supreme Court has said that location where salary is received is not important. Again, in recent decision of Texas Instruments, similar view has been taken by the court. And in the 2015 decision of Robert Arthur Kells, there the employee came to India for 2 years, and 1 year he was in US, and for 2 years he was NOR. He filed his tax returns in India and offered his income in India. That the tribunal held that from the time the ESOP was granted and to the time when the ESOP was exercised in India, the time for which Robert has worked in USA will not be considered for the purpose of taxation of ESOP in India. So therefore, most of the outbound litigation is in this area. And let us come to the inbound types of litigation in India. Any question, Rajesh, on this issue? Because now we are going to the inbound deputation. We have covered outbound deputation.
We have received several questions. Would you like to take now?
If you think something is important arising out of this, we can definitely take one or two questions.
See, one question is what are the tax implication of phantom shares issued by parent company? So that's I think you will be covering now.
Phantom is similar to SAR,
Okay.
stock appreciation rights.
Hmm.
So we have already covered.
Okay. Is ESOP an operating expenses while computing operating margin for transfer pricing?
I will not comment on transfer pricing.
Okay. Then, in light of the Finance Act 2020 amendment of new personal tax regime, if the employee chooses to opt for a new personal tax regime and later at the tax return filing stage, if it chooses to opt in, there will be a shortfall in the tax liability. Will employer be held liable for the shortfall in deduction of tax?
See, employer is supposed to get the declaration from the employee while deducting taxes as per the provisions of Section 192. If a declaration has been made by the employee and if the tax has been deducted based on the reasonable belief by the employer, there will not be any problem for the employer.
Then one of the question is in an employee of Indian subsidiary of US holding company has been offered ESOP. One second.
Indian
Has
company, it is an
Indian
employee of
subsidiary
Indian.
of US holding company has been offered ESOP of the said US holding company and the same is vested 3 years ago. The employee has not so far exercised rights. Now US company is paying cash for redemption on right to exercise to the company. Whether the
I think
same is taxable as capital gain or income from other sources
we are
or salary.
covering that in the later slide, so we will
Okay,
skip this question now.
okay. Then is one is a trust structure. Do you want me to ask the question on one
Yes,
structure?
please.
Yeah. In the case of trust structure, if trust has acquired the shares, say at rupees 100 in year one, and transfer it to the employees at 1000, that is exercise price in year three, whether trust is taxable on the difference of rupees 900 as capital gains?
See, the income is to be taxed in the hands of the beneficiaries under the scheme of Section 164. So, trust will not be taxed except there is a current income on such shares because the beneficiary were always the employee. Beneficiary were always the employee, and therefore trust will not be taxed on such amount. It will be always the beneficiary who will be taxed. And if the beneficial provisions cannot be quantified, then trust will be taxed on such gains. However, the taxes paid by the trust is on behalf of the beneficiaries and not the trust taxation. Is that clear?
Yeah,
Okay, so we go to the next.
yeah, right. I think we can. Then FEMA provisions will be covered or not related to ESOP. I think that you are covering later on,
We're
right?
covering, yeah.
Yeah. So I think we can just continue because others are inbound. So this we are covering now.
Okay. So now we have understood how the salary in general is taxed in India and how ESOPs are taxed in India on an exercise price basis. I have not covered the recent provisions which is introduced in the 2020 Act, where the ESOP taxation is also deferred for 5 years, and taxes are required to be paid on the earlier of the three events. But then that's a simple to understand once we have grasp over the subject. So therefore, I have not covered this in order to avoid any confusion. Yeah, because then initially in a draft bill they only provided for the TDS provisions but was not provided in the charging section, and then they've done something at the final level, but that is a history now. So now coming to the inbound deputation. What is the inbound deputation? It's a foreign company's employee working in India, and therefore the payment made by the Indian employee is to be taxed. in the hands of the employee. But the major discussion and the litigation on inbound deputation is minimum on these issues of the employee salaries and etc. The largely the courts in India has invoked the income from deputation of sub employees as fees for technical cases in some cases. In some other cases, they've said that due to the presence of these employees, the foreign company has a permanent establishment as held in Morgan Stanley's case. And also, the final litigation was in the case of Centrica, decided by the Delhi High Court in 365 ITR 336, following the Morgan Stanley's case, that due to the peculiar situation in Centrica, it was treated as not the employee reimbursement income, but it was an income in the area of fees for technical services chargeable to tax in India. And thereafter, the number of decisions in this area have been a matter of distinction from Centrica. Wherever the courts wanted to give a favor that this particular deputation is purely a manpower substitution or manpower deputation, then a reimbursement of such salaries should not be tinkered with FTS clause or with service fee or with a permanent establishment of dependent agent personal test. So with that, I would like to just touch upon what type of litigation took place in the Centrica. The courts have looked at that he was a CEO of an Indian company. Indian company was providing the intragroup services. The entire operations was like a support to the foreign company. The employees' risk and reward were taken up or shouldered by the foreign company. Employees' employment cannot be terminated by the foreign company, but no rights to Indian company. In such peculiar circumstances, courts have held that it is not a reimbursement of salary, but it is a income from fees for technical services. This is and the other area of litigation like ESOP, net of tax payment, social security contribution, daily allowance, transportation allowance of deputed employees by the foreign countries to the Indian companies are more or less settled, except on that receipt-based taxation which we have discussed, which will still continue for some time unless a proper decisions of the highest court is obtained. Now we take to the overview of the issues in cross-border taxation. Now what happens? We have now discussed about the stock option, a tax treatment, their inbound versus outbound centric from India taxation. And now we are covering the global taxation of the employees which are moving from one place to another place and what are the issues involved in such taxes. Now, we are told that how such income could consider for the purpose of global taxation. We are told that there cannot be any special tax treatment to such issues because they are also part of salary and therefore it should be properly covered under the salary income only. Now, two issues arises because of this particular income to be included. This particular income to be included in the salary, because most of the other items of salary are arising or due or allowed or paid or accrued or arises while employee is serving the employer. Whereas these ESOP and the income from such ESOP are arising while you are with maybe at different place and at different place who are taxing the same income in a different manner. Just to give you an example, there are two important issues therefore arises. One is An employee in a country A, if it is deputed to country B, and while he is a resident of country A, then in such a case, if country A taxes on a grant basis and country B taxes on an exercise basis, the two things will arise. One is country A has already taxed because he was resident at the time of grant, and country B has exercised his employment in country B. There was a right to tax on an exercise date the same income which has been taxed on a grant basis in country A. So one is, second issue which arises is the country A is taxing the income on a grant basis, and therefore it cannot be income other than the salary. It can be taxed only as salaries. Whereas if a country B is taxing the entire income on the basis of sale of shares, then it will tax you on a capital gain basis and not on a salary basis. Now, there were two conflicts that arisen. One is a time-based conflict, and another is a characterization of the income conflict. So these two conflicts has to be resolved in order to tax the income. So this is timing mismatch in taxing the employment benefit and distinguishing employment income from capital gain, differentiation in source rule, taxes, etc. Now what the real issue is? You are already taxed in country A, work 7 months in state B, part of the remuneration in state B was stock options of company Y, a resident of state B. So he was working in state B for 7 months, and company was also located in state B, but he was a resident of state A. What will happen? Because X is exercising the option in year 1, when he's taxed in state A. And if state B taxes him on a capital gain basis in year 3, then the capital gains tax is payable in state B on a source basis. Now, the issue one is both the country have taxed the income. The country which is a resident must resolve the issue by giving the tax credit, as we all know from all the international treaty provisions, that the source country taxation must be given credit in the resident state. Now here, employee X is a resident of state A who is already taxed in year 1, and now he is again taxed in year 3 in state B. So what will happen? X has to get a tax credit of taxes paid in state B because he is a resident of state A. It is an obligation on state A to give tax credit of taxes paid in state B, which is a source state. Now, the other issue which arises is, since capital gain tax is paid, what will be attributable income which is taxed in state A on which credit can be given? Excuse me? Rajesh, anything for me? Okay.
No,
Paritha,
Paresh,
you can
continue.
Okay. So therefore, as per the normal provisions of treaty, state B can therefore tax the gain in accordance with the Article 15. However, yes. Yeah. And state A, the employment benefit resulting from stock options correspond to the difference between the shares when the option is exercised and the amount paid by the employee. That benefit is taxed. So therefore, there will be some loss of credit because state A will treat this as income. Let's say state A has taxed on a grant basis or a exercise basis in year 1 on $100, and State B is taxing on $200. Now, $200 tax payable in the state B is on capital gains. Now, state A is obliged to give credit of the foreign taxes paid on the income which is taxed in state A, not on the income which is earned in state B. And therefore, the credit will be given only on the income of $100 and not $200. And the rate at which it will be given credit will be the taxes payable or paid in state A and not what is paid in B. These are the issue involved, which will create some double taxation in some manner in this issue. That is what the purpose of this issue being taken here. Now let us take the another issue, which I have provided the support of entire treatment, what state A has to do in such cases from the OECD commentary of Article 15 and Article 23 and 23B model. Now the question arises in the question study 1 is, can the state who have no OECD model in the line of 23 and 23B can give a credit? Because the OECD model very clearly says that the timing difference must be ignored for the purpose of credit of taxes of source state. And therefore, the law of the resident state must allow to resolve such timing differences and the credit must be given. However, let's take an example of India. If India is either state A or state B, let's say state A, how India would give credit? India probably would say that I cannot reopen the assessment and therefore credit cannot be given for the past years. Also, probably India will say that you file a revised return, but there is no time limit remaining for revised return. So therefore the credit will lapse. However, if you see some remedies in the form of circular of 2010, that you can get a refund of taxes even if the tax return is not filed. Such some machinery may be provided by the countries which has not framed their tax credit article in the line of the OECD model. Now that brings me to the issue number 2, which is recognized by the OECD. What is this issue is? It says that whether a resident or not a resident, how the source state should taxes this income. It says very clearly that if an employment is for 3 years and the conditions to vesting is also 3 years, then the source state taxation should be in accordance with the number of days of the employment exercised in that particular state. However, a difficulty is created because of the residency status in a particular country, because the employees are also taxed on a worldwide basis where they are resident. So in those cases, source state taxation credit may not be available to them in a peculiar circumstances. Because if source state cannot tax the income of an employment based on the treaty with the India, let's say for example, then whatever taxes are payable by the source state or receivable by the source state is not able to charge because of a treaty, and the entire income will be therefore charged in state A only. Now, this particular situation would create an anomaly in the tax credit. How that tax credit can be resolved? Go to therefore example 3. What this example 3 says, that and we will understand more clearly what is the problem which will arise if the countries involved are more than one. Listen very carefully. Let's say employee was an employee in state A. He has stayed in a particular year after the grant of a option 110 days. Sorry, 90 days. And then in state B, 100 days. And in state C, 20 days. And in state D, for rest of the time. For about rest of the time of the 3 years. Now, it is told to us that the state A taxes the employee on the basis of the grant when he is a resident of that state. So state A has already will be taxing on the basis of grant. Now state B has also a right to tax because the presence of the employee in state B exceeded 183 days based on the 12 months period immediately before the arrival into state B. Although he is not resident, that is possible. We all know that if the employee arrives in the part of the year in a particular year, which is not exceeding 183 days, but in the next year, he will exceed 183 days, and right to tax will arise under Article 15 for the tax under the tax treaty between A and B. So this is how state B could tax the employee stock option because of the number of days stay exceeded, but he is present in that state only for 110 days. And then 20 days in state C and about 440 or odd in state D for year 2 and 3. Now, how it is very simple. How the allocation can be done? That let's say 220 into 3, 660 days are the working days. Because employment exercise, we will remove the days of leave and vacation, etc., for the purpose of simplicity. Then state A has a right to tax 90 upon 660. State B has a right to tax 110 upon 660. And state C has no right to tax because there's only 20 days. The threshold of Article 15 does not arise if we consider the tax treaty between B and A and B and D. Sorry, C and A, C and B, C and D. All three treaty will not allow state C to get their share of income from the employee stock option. But D will also be able to tax on the basis of the 2 years stay in state D. Under its treaty with C, B and A, because it will treat A as a source, B as a source, C as a source, and it will be because at the time of exercise or a sale, the employee was resident in state D. Therefore, state D will apply the treaty with all the three states A, B, and D, and it will try to give a credit to all the three states if possible. But what happens at the end? A has taxed the income on the basis of the grant in year 1. It was already taxed after considering the treaty between A and B because B was a source state and he has given a credit of what is taxes paid in B. When it comes to D, D does not give credit to anybody. B does not give to B or C. He cannot give credit to A also because A has acted as a resident state while taxing this income in the hands of the employee. And therefore the conflict arises, and this income, and therefore the income which is accrued in state B and C, a part of it may be doubly taxed in the form of taxes paid in state A and state B, because C is not able to charge anything. And therefore this analysis is very important for the purpose of right of source state to decide how much is attributable portion of ESOP in that state and how much credit a state of resident must give, because state of resident will not give credit of whatever tax is paid in source state, but it will give a credit in accordance with its law, appropriate portion of taxes which is levied at the time of grant. So this is the issue which is involved at the time when the employee travels from one state to another for the purpose of employment in one place to another place. The OECD has said that no matter whenever the issue arises of the event of taxability, each source state must have a right to tax the allocable portion of the ESOP taxes there, irrespective it is paid when the liquidity has arose in the different state. The issue therefore arises if a state has not taxed on a grant basis. Let's say A also has a similar basis of taxing on exercise date. Then A is not taxed. D will tax on an exercise date. How A will tax the income? Because A will then become a source state because it was not taxed while it was a resident state, and therefore D will be able to give appropriate tax credit to state A if they were able to tax this particular income on a source basis. And this is how probably conflict can be resolved. Otherwise, it will be either double taxation or it will be no taxation. And this is the support on the subject matter for resolving the tax credit issues. And this example, same example, I've already discussed, which I have given the complete elaboration in order that you can relax and read later on. Now, any question, Rajesh? We have completed the inbound, outbound litigation and the cross-border litigation, and we come to the FEMA aspect of the transaction.
Yeah, there are various questions that we have received. Neeraj, can you read it? Neeraj?
Yes, sir. I'll do that.
Yeah.
So, sir, one question that we have is regarding.
You can come on video now.
Yeah, I'll just come. Just a minute. Hello. Yeah.
Yeah.
So just I'll just browsing through. So there's one question which says that for a foreign employee receiving Indian company shares, the foreign employee while selling the shares, the cost of acquisition would be taken as excess price and not fair market value, since cost of acquisition as fair market value is eligible only when an Indian company pays perquisite tax.
Now, Indian company has issued shares to the foreign company.
Correct?
Correct?
Yes.
Now, the Indian company is not supposed to tax any value because the concerned employee is non-resident. Salary is accruing or arising outside India, therefore is not liable to taxation at all. So where is the question of taxing such ESOP? First of all, if we are taxing, then the issue will arise.
Correct.
Is that clear?
Right. Yes, sir. I think that's good. So then there's question on the expenses that will be allowed to the Indian entity. So the question is that whether the difference between the market value as on the grant price and the excess, the difference between the value as on the grant price will be allowed, or the fair market value as on the excess price will be allowed as a deduction to the Indian company.
See, the shares are issued by the Indian company only when option is exercised by the concerned employee.
Correct.
At the time of a grant, if there are any money received by the Indian company from the employee as a token money, because he is entitled to get the option granted, because full money may not be paid. So the part of the money will be paid by the employee at the date of exercise. So therefore he has paid, let's say, $1 in total at the time of grant and at the time of exercise. Now, if shares are issued at a discount, what are the entries passed by the Indian company in the books of account? If it is option, there will be different treatment. If it is shares are issued at a share purchase scheme, it will be discount which will be allowed to Indian company in the profit and loss account. Whatever it has spent and incurred on the basis of the capital raised in the Indian company's books, that only will be allowed. Notional loss will not be allowed. Let us say, for example, in the preferential allotment of the shares by a listed company, the shares are issued at 100 rupees discount to the public price. There is no allowance of 100 rupees in profit and loss account, isn't it?
Right.
A similar is the concept in the ESOP also. Is that clear?
Yes, yes. Okay, thanks.
And particularly the example would be appropriate where Indian company has purchased the shares from market and issued to the employees at discount. Then that discount will be the cost of the company. That's a correct example probably if you want. But in the case of grant and option, there won't be any actual cost incurred by the company if they have received the price of the shares which is at which they have granted the option.
Right. I think other questions.
One question you can take, then let Paresh proceed.
Yeah. I was thinking, I think there's some FEMA.
So,
I think Paresh bhai, you can continue now.
I think,
okay.
Yeah. Paresh bhai, then.
Yeah, Neeraj, can I continue?
Yes, sir, please.
Okay.
One question, Paresh bhai.
Yes, please.
Interplay with Supreme Court decision in the case of Eli Lilly.
Yeah. What is your issue?
No, it's just written now. There is an interplay with Supreme Court decision in this case of Eli Lilly. I think in the question of ESOPs, the Eli Lilly decision of Supreme Court will have any effect.
I'll tell you, even in Emil's Weber case, followed from Eli Lilly, it was taxed on a receipt basis. We already discussed how receipt basis will work and will not work. So we'll have to identify those situations.
Okay.
Because Emil Weber's also, but of course Emil Weber's on a different aspect. It was on the issue of totalization equalization levy, whether such levy was received by the employee or not. See, I'll tell you, there is a section 17.2.3 and 17.3.4. 17.2.3 is on value of any amenity or benefit, and 17.2.4 is on any amount of benefit which but for such would have been payable by the employee. Let's say for taxes which are paid on the income earned in India by the employer, because there is a tax equalization agreement. The question arose whether it will fall in 17.2.3 or 17.2.4 for the purpose of section 192. 192 says if it is a non-monetary perquisite, 192 does not apply. Now, 17.2.3 talks about amenity or benefit. So whether a tax equalization difference paid by the employer is an amenity or benefit, or it is a payment but it is paid by the employer, it would have been paid by the employee. There are differing judgment. One view is that yes, employee would have paid under 17.2.4 and therefore it is a benefit. The other view is from the perspective of the employee. Although employer has paid, from the perspective of the employee, when his employment agreement was drafted, his foreign salary was considered and he was told that you will get the same net of taxes salary, you will not get anything extra. If there is a benefit in taxes, it is mine. If it is loss of the taxes, it is mine. And therefore, for the purpose of benefit to the employee, whether it is accrued to the employee or not, the answer is no. Because by virtue of additional payment made by employer, he is not benefited at all under his contract. So therefore, you may distinguish this situation. If you take it from employer side, it may be treated as in any of this section. But if you look at from the perspective of the employee, I think then there are reconciliation between those decisions. I think this decision will in this line only. And probably if you want to see the support, then I can give you support a little later offline. Yeah, next question.
Okay, I think you can continue with this your presentation, then we will see after.
Okay, so FEMA, again, we are concerned with the inbound employees as well as the outbound employees. Inbound employees means shares of an Indian companies are issued to the non-resident employees. That means we have discussed hotly the issues of section 5, explanation 2 to section 5 and section 15 under the tax law, that these shares, and therefore we come to the FEMA notification 20, now replaced by NDA rules. Rule 8 says that the stock option can be issued, set equity share can be issued to such employees in accordance with the company law guideline in case of unlisted companies or the unlisted public companies, and in accordance with the SEBI guidelines for the listed companies. And procedure has been laid down. Reporting guidelines are also available, and therefore, which is very well permitted. Now, in case of outbound employees, which are Indian citizen or Indian resident going abroad for the purpose of employment, then this is an investment, or they are not going for the purpose of employment, but they are issued shares of a foreign parent and they are employee of the Indian subsidiary. That's a proper case. In such cases, we have outbound investment notification 120, which talks about various situations where employee stock option can be given to the Indian employees of a subsidiary of a foreign parent. So Indian employee of a subsidiary company in India will get the shares of a foreign company. Now, that route is available on a cashless option, on a payment basis, under the director's qualification, under the ADR, GDR issue by the Indian company is also can be given to them, because ADR, GDR is a security situated outside India, but of an Indian company only. So these are the availability of an option for inbound as well as the outbound type of investments under the ESOP scheme. And the provisions are facilitating either under the inbound NDA regulations or outbound notification 120 of the FEMA. Well, I've given the complete breakdown of how it is possible. So that brings us to the SEBI regulation for ESOP, an overview. Any questions on FEMA?
Paresh bhai.
Yes, please, Rajesh.
Yeah, you can complete the presentation and then we'll run through all the questions.
Okay. So, see, the SEBI regulations and the company issue of shares and debentures guideline 2014, in most of the places they are in sync, because the guidelines of the company issue of shares and debentures applies to all the companies, which include listed companies, and the SEBI guidelines applies only to listed companies. Therefore, there may be some kind of discrepancies between the two guidelines that you must look at, because even employees at certain places defined differently. Somewhere associate is excluded and somewhere it is included. Valuation procedure under SEBI guideline is a merchant banker, whereas under the company rules, a registered valuer. Then the percentage guideline, the value guideline, how many shares of a face value or a total value of shares at a market FMB price can be issued under both the guidelines. How many, under what circumstances a non-voting shares can be issued. Now, if you see, certain companies do issue a non-voting share under the public issue or under the ESOP also. The company guidelines is very restrictive in case you want to issue the shares under the non-voting scheme. A long laundry list of the restriction. Even if financial statements for last 3 years are not furnished, you're not able to issue non-voting shares. Also, if you are under the investigation list of, not only investigation list, if the matters are pending at the tribunal level for adjudication, then under FEMA or under PMLA or any regulators issues are pending, then also such shares cannot be issued. And therefore, when advising client on issue of shares of schemes with the desired list of the client on restrictions or the flexibilities must be looked into from the background of the SEBI regulations as well as the company regulations on the subject. So then it brings us to the accounting aspects. Prior to the issue of Ind AS 102 on share-based payment, there was a ICAI guideline of 2005 on the subject, which also is still relevant on some of the aspects for accounting treatment and valuation and the disclosure requirement on the financial statements and in the board of directors reports, and also the statement to be annexed with the notice of the special resolution are all important for the purpose of accounting and auditing the books of account of such companies which has issued the ESOP and the shares are outstanding, and the tax and the treatment in the accounts which are given in the profit and loss account as well as in the balance sheet, as we have discussed earlier. So these are the issues: method of valuation, measurement date, period of booking, and recognition of ESOP in the books of account. Now coming to the employee stock option in the foreign countries. If you see, each country has devised its method to tax the stock option differently. In US, they have a different method. They have kept a long period of exercise, and the way of life is pay more option than the cash. And I've seen in most of the large companies prior to the evolution of the digital model companies, most of the employees have lost heavily on the stock options being given to them as a part of the salary package. If you see the financial services company, the hardware companies, let's say IBM, banking sector in US, and in US, as much as 30 to 40% of the salaries are paid in form of the stock options. And when you exercise, the most of the time, the listed price at the time of exercise is much, much lower than the value at which it was given. And typically, most of the regulations say that if the price is lower at the time of exercise, nothing can be done. Why? Because exercise period is long. Let's say exercise period is 4 years to 7 years, 4 years to 8 years. Then people who have already exercised their rights at a higher price, you cannot change the method of charging at a lower price for other employees when there are already outstanding shares which are issued at a higher price. So these are the issues involved in terms of employee stock option when the different methods are utilized for the purpose of issue of shares at a fair market value on a particular date. If a fair market value were to be considered when the employee wanted to sell the shares, then there would not be any issue. SIR also will not be an issue. But in these cases where the gaps are many and the options are many, the number of issue arises. Even in Singapore, if you look at, as I told you earlier, that the options are taxed on the day of grant if there is no vesting period is specified. Because I'll tell you a typical situation. Certain companies decide to reward their employees on a current date for the past performance. And if they want to issue options without vesting period, because they want to start the scheme. When they start the scheme, the benefit is taken by the newcomers or the new employees, that must be granted to the old employees to put them at par. In such cases, there may not be any vesting period and may not be more than 1 year or so. And for other employees, it could be more than 4 years because they have not worked for 4 years, but the past employees already worked for more than 3 years or 4 years. So in such cases, the taxability and the schemes differs materially. Also, you don't want a dilution little now. So therefore, if you don't want dilution, then the shares will be purchased from the market to given it for giving it a discount to the employees. Also, number of methods are employed to reward the employees with the cash. The company have used the buyback option and paid taxes on buyback under Indian situation. But if the shares are sold in the open market by the employee, the taxes will be paid by them, right? So the scheme and the incentivization will differ based on the taxability option at the time of issue and taxability at the time of redemption. This is what I wanted to cover by incorporating the different stock option situation which country has offered you in the international area as compared to India. So this is a UK overview, and we have the overview in Singapore and the tax implications. I think by understanding the tax implications for outbound and inbound, and also understanding the options of a global employee as per the OECD commentary, probably this becomes very simple for us to understand. Therefore, I don't want to write and read everything, which is already given to you in a detailed form, not on a single line bullet for the purpose of its historical value in time to come. This is the article 15 of the, okay, there is a mismatch. This slide was supposed to go on page number 28, which has come at 73. Sorry for this. I wanted to enlighten you on article 15, but this is 28. Wrongly, it has come to 73. Sorry for this error. Thank you very much, friends, for patient hearing. And floor is open for question and answer.
Yeah, Paresh bhai, we have received various questions.
Yes, please.
So I think Neeraj will read one after another.
Yes.
And then you can just respond to that.
Yes, sir.
Yeah, Neeraj.
Sir, first question is like, if ESOPs involve any foreign remittance by individual employee, will RBI approval be required or any other procedure needs to be done?
See, there are limits specified in the regulation 120 of regulation of 120 in part regulation 120 in part 2 in part 3 for the categories in which you are sending the remittance. Now, if you are an ESOP holder without payment, then no cash will be required. If it is on a payment basis, then payment is allowed under the LRS schemes. There are percentage specified that not more than so many percentage of shares can be issued under the ESOP by the foreign company, because that situation cannot be misused for the purpose of foreign direct investment in that company in the name of ESOP. Then directors' qualifications are not exceeding 1% of the qualifying shares is also covered in that categories. And then ADR, GDR option also covered for the purpose of Indian company up to the $50,000 per employee. So therefore, there are automatic route, and if amount is exceeding this provided in the automatic route, probably you can approach Reserve Bank of India. Otherwise, you don't have to approach Reserve Bank of India. If you approach Reserve Bank of India, then you will have to give the entire details of the scheme and why you are placed outside the limit specified under the Part 3 of the Notification 120.
Next question is, under NDI rules, permit issuance of ESOPs to employees of overseas JV was, which is in accordance with Companies Act. Would cash settled SARs be permitted under FEMA, considering that Companies Act is silent on issuance of stock appreciation rights?
Yeah, it will be permitted. Because company law provides for that, no? Company law scheme provides for that.
Thereafter, under FEMA, whether payment of exercise price can be made to the foreign company by an Indian resident individual by reduction in eligible shares proportionate to the exercise price to be paid by foreign company. So instead of making the payment, can they take less number of shares in lieu of the payment?
Yeah, that is possible in the case of equity settled stock option appreciation rights. Equity settled appreciation right. And appreciation is given to you. Against that appreciation, you can take the shares.
This one question that
FEMA very clearly says it has to be in accordance with the scheme framed by SEBI for the listed companies, and for other companies, the Company Issue of Shares and Debenture Rules 2014. So FEMA is not controlling any such aspects except what is stated in those guidelines. If it is within those guidelines, it is available.
So if you are following SEBI guidelines, then I think FEMA is permitted.
Yeah, that's what the FEMA says.
Inbound and outbound, both there will be no restrictions as far as if you are following the SEBI guidelines.
Yes, both the guidelines, yes. Okay. No, both the guidelines are for Indian companies.
Okay.
So outbound will be restricted by the Notification 120 only. Because there is no reference to foreign companies guideline in outbound.
Okay.
Next is, in case of cashless ESOPs issued to Indian residents, no, in this case, cashless ESOPs, then ODI will not come with. So in case of cashless ESOPs issued by Indian residents by an overseas entity, as per ODI, any filing prescribed to made with RBI?
No filing is required.
No filing is required.
No filing is required because it is falling in Part 3, which is other than the direct investment.
Okay. This question, is FCGPR required to be filed if an Indian listed company has granted ESOPs, but no shares were issued?
If FCGPR is required,
if an Indian listed company has granted ESOPs, but no shares were issued, I'm unable to understand.
Yeah,
no shares were issued.
He says that the whether at the time of granting any procedure is required. Right. See, this is the slide number 61. At the time of granting, there is a reporting requirement.
Thereafter,
one of the question, Paresh Bhai, is what is the tax implication when founder settles shares in ESOP trust, whether provision to 47(3) and 56(10) is applicable?
See, we have discussed that the exemption, the exempt transfer which are given under Section 47 is not applicable to settlement of the founder's shares to the irrevocable ESOP trust. And therefore, it will be treated as a transfer. That when you say that this is not an exempt transfer, that does not automatically mean that it is a transfer will be covered by the settlement. Right?
Okay.
So, it is open for the revenue to consider either it is under Section 45 read with 48 or under 56 to 10. If they treat it as a gift, then 56 to 10 will be able. But if we say that it is not a gift without consideration, because it is benefiting the company where he is a large shareholder, then it will fall within the parameters of transfer of shares subject to capital gains, or it may not even attract the capital gain tax provision because it's not a transfer. Because settlement to a trust is not treated as a transfer per se.
Okay. Yeah, Neeraj.
Yeah. Then the question is, when will the employer get deduction of ESOP for tax purpose? Year of vesting, year of exercise, or proportionately during the vesting period?
See, whenever you are issuing shares, either cashless or at a discount, and if you have incurred that cost, that time only it will be available to the Indian company. If he does not spend any money, let's say if I issue the shares, what will happen? Let's say issue of the shares has to be done at an FMV.
Correct.
Now, if we issued shares, let's say at FMV, then FMV is X, and the grant price is lower than X. And if the Indian company is capitalizing to its reserves, the FMV, then the difference between the grant price and FMV is what is capital profit and loss account can be debited. That's what the treatment is.
Correct.
Because it creates a stock option reserve on the liability side of the balance sheet.
Right. So then are options not exercised in a foreign company required to be disclosed in foreign asset and liability schedule by Indian tax residents?
See, any option of an Indian resident in a foreign company is a contingent right? Contingent right on happening of certain event.
Correct.
If it is a contingent right on happening of such an event, it is not right in real sense, right? Unless it is exercised. So till then it will not be covered under the foreign exchange assets and liabilities of the return. And I believe individuals are not supposed to file FLA return probably.
Right, sir. But in our ITR, vis-a-vis the Black Money Act, the schedule for foreign asset and disclosure, even there we say it is a contingent right and not a capital asset to be disclosed.
Because there the requirement under Schedule FA is any interest in the securities. So that is different than the assets, right? Any interest in the securities. So it is an interest in the securities, maybe disclosed in Schedule FA. Because it is an interest in the securities, isn't it?
Interest. Correct.
If you see the definition under 17(2)(6) of the securities for the purpose of perquisite, includes any option in such securities. So taking an analogy from there, it is better and appropriate to disclose in Schedule FA that you have an interest in this financial instrument.
So whether any FEMA compliance are to be done in case where cost of ESOP issued by Indian parent to employee of foreign WOS is shown as equity contribution in the books of foreign WOS.
So you are saying that there is some cost reimbursed by the foreign WOS,
yes.
right?
Yes, right.
To that extent, cost of Indian company debited to the profit and loss account will reduce. Of course, there won't be any income, right?
There will not be income.
Yeah.
Right. But sir, if it is shown like instead of charging, it is shown like a equity contribution. Then
it is not an equity owned by the foreign company, right? It is equity owned by the employees of a foreign company. So how it is possible to credit it in the name of the foreign company? It will be income or charge to the profit loss account.
Correct. Right. So whether Indian company would be required to file FLA for exercise of ESOP granted by foreign parent company? Any FLA reporting?
The foreign company has granted, this is what you are talking about, the inbound deputation.
Right.
Foreign company has granted
Okay.
the stock option to the employee of a subsidiary in India,
Structured in India. Right.
right? So nothing to do with the Indian company, right?
Indian company. Correct. So no reporting requirement.
Right? There's nothing to do with the Indian
Right.
company.
Correct. Right. And so if it is vice versa, then Indian company has issued shares, then FLA would be required because
Indian
then you have
company,
a non-resident as a shareholder. Indian company has issued shares to employees of a foreign company.
Mhm.
Even then FLA would be required because
Indian
then
company has issued option or shares.
shares,
If
equity
Indian
shares.
company has,
Option.
say, let
Indian
us say,
company.
Indian company has issued option to the
Hmm.
employee of a foreign subsidiary, right?
Yeah.
Correct.
No. Option to issue shares in future.
Hmm.
Option to issue shares in future date at a predetermined price. Right? Is it a liability? Is it a liability?
Until exercised, no.
It may be a contingent liability.
Certain liability.
Contingent.
Yeah. Right.
Right? The contingent liability under FEMA of an Indian company is a capital account transaction.
Okay.
So Indian company, while issuing shares option, while issuing
Okay.
option, there is no requirement under the NDA rules.
Hmm.
There is no. Now you are coming to annual FLA. Now, if a FLA requires you to consider the contingent liability, is there any contingent liability on the issue of option? Technically, no commercial liability under the accounting principles. There is a contingent liability only under FEMA. So FLA may not apply at the time of grant. At the time of issue of shares, you already issued the shares and received the payment. So there is nothing is pending. So at that time also
Right.
nothing will be required.
That one. Correct. Right. Whether 56.
Actually, last question, Ma.
Yeah.
If a payment has been received by the Indian company at the time of grant, then that will come under the annual FLA.
Sorry, come again, Paresh.
If a payment has been received by the Indian company at
Okay.
the time of grant, let's say token payment
Hmm.
from an employee of a subsidiary, therefore that will appear in the annual FLA.
Okay. That means you have
So
issued
foreign
it at a
exchange liability,
discounted price.
foreign exchange liability, if it were to fail on the
Okay.
exercise date.
Okay.
Whether foreign holding company can issue ESOPs to employees of Indian subsidiary LLP.
Foreign company,
Foreign company can issue ESOPs to employees of its Indian subsidiary LLP. Indian LLP where it has 99% stake.
see, it's again a foreign company issuing shares to the employee of the LLP. They are individuals, right?
Right.
They will still be covered by notification 120.
120. Correct. So, right.
Okay. One of the question, Paresh, is can the resident state deny tax credit saying that tax is not deducted by the source states in accordance with Treaty of Resident State with such source state?
See, if this state source has no right under the tax treaty, let's say in a typical case of state C versus state A in our example, the C has no right under the AC tax treaty to tax the portion of the employee stock option for 20 days out of 660 days. and it has deducted taxes on the portion, then state A being a resident state or state D being a resident state are not obliged to give such tax credit.
So they can deny that.
Because tax has to be deducted in accordance with the treaty. Now, but the timing difference and the characterization difference cannot be an issue for not giving the tax credit by a resident state.
So one question is that we understand salary accrues at the place where the employment was exercised. If that is a general principle of accrual, then why do we need a deeming section 912?
I'll tell you. See, prior to the text of 912, there was a decision in SG Natale in 124 ITR, where the courts have held that the income is deemed to accrue or arise at a place where the payer is located, not where the employment is exercised. And therefore, it was required to amend and clarify that income will be deemed to accrue or arise for the purpose of including under the head salaries only if the employment is exercised in India. That was the reason of changing the language at that point of time and introducing 912. Is that clear?
Yes, sir. That's clear. Yes. Sir, are shares settled RSU covered under 17 subsection 2?
RSU are not covered under 1726. Stock options are only covered.
Okay.
If because see, restrictive state, they are shares. They're issued probably at the time of issue only. So there was no option in that in RSU. If there is no option, then that is not governed by 1726. You know, look at the what is issued under RSU. There are the share issued, restrictive share right? If there are shares, then it will not be covered by 1726. It will be automatically shares given to him at a concessional price.
So
See, when
in that,
a value of concession given upfront is treated as salary itself, value of any benefit or amenity, probably it will fall in 1723 and not 6. Value of any benefit. So the benefit is derived by the employee, which is either a discount or a concessional price.
so sir, but this will not be taxed under 56 to 10. We said it will be under 17 only because it is a benefit.
Because the shares are issued only for the purpose of employment, right?
Right.
If you are not an employee,
you will
the
not have received
options are or the shares are not issued to you with a vesting condition. It is right.
Right.
So if you are not an employee, it will not be given to you, and it is part of the service package only, contract of service only.
Right, and there will be a
You
scheme.
see in the documentation which I have provided, there is an ESOP documentation. The ESOP agreement between the employee and the company, the trust deed, the agreement of administration between the trustees of the trust and the company. They're all ESOP documentation which are only arising out of the employment of the contract.
Any more questions? Neeraj?
Just a minute. I think this one we have taken. So, what is the taxability of stock options exercised by the legal heirs in case of death of the employee?
The legal heir is also receiving the same nature of income under the contract with the deceased by the company, right?
Hmm.
So legal heir will have to offer that income as salaries in the hands of a deceased if the deceased is filing the last return
Hmm.
as an administrator. Or if it is an income, then it is an income of received from. See, the question is it is received from the company and not from the deceased. So if we say that it is received from the company, then a different issue. But if you say that it is received by way of a will,
Hmm.
right?
Hmm.
Or if there is no will, it is received because of the operation of the law,
Hmm.
then it will be a gift at the time of will, right? So it won't be taxable in the hands of legal heir.
Correct. But and otherwise, if it is exercised because of the death of the employee, then it will be in the deceased return as a salary income.
Yeah.
Right.
But
And
after he has deceased, after say 2-3 years, it is exercised.
then
Whether still it will be in the hands of deceased return or it will be in the hands of the legal heir. Correct, bhai?
Yes.
Suppose on the death of the employee, the
Mhm.
legal heir gets the access to exercise his rights after say couple of years, and still whether he will have.
See, you have to decide whether it is a will gift or not,
Hmm,
right?
okay. If he, so if he,
Up to the date of death, whatever the rights value is there
hmm,
will be treated as the gift. Accretion and addition after that date will be the income of the recipient.
okay.
Let's say he has exercised the right, is the proper situation.
Hmm,
So right was exercised by paying the price.
yeah.
So therefore, the benefit which was granted to an employee is now received by the legal heir.
Hmm,
Whatever now happens after the sale will be capital gain in the head of legal heir.
okay.
What is contemplated on the date of death is an early exercise date, right?
Hmm,
Early exercise date by the legal heir. So whatever benefit accrued on the exercise date is a gift on will or by operation of personal law in the Succession Act or whatever.
yeah. Interested.
After that, whatever happens is the capital gain in the hands of the recipient of the under the
Recipient.
will.
and so I think this is the last question that in case of shares issued by foreign company to employees of Indian subsidiary, the withholding tax liability would be of Indian subsidiary because those are employees of Indian company, although the ESOPs are issued by the foreign company.
Again.
So, in case of shares issued by foreign company
Mm-hmm.
to employees of Indian subsidiary,
Mm-hmm.
then the
Inbound
withholding
development.
yes, and then the withholding tax liability on exercise would be of the Indian subsidiary or of the
See,
foreign company.
see, on ESOP, right?
On ESOP, yeah.
The foreign employer has issued the shares
Hmm.
to an employee of an Indian subsidiary. In most of the cases, payments are routed through Indian company. If there is an agreement to bear some cost, that also is Indian company is paying. And most of the payments which are received either on appreciation or etc. in real life is paid through an Indian company. The Indian company becomes an agent of a non-resident. And therefore, if there are any taxes payable on such option being exercised and being treated as income, then that is included as a declaration by the Indian subsidiary employee at the time of application of Section 192. And if that income is included by a declaration by the Indian employee, then the TDS provision will apply vis-a-vis the Indian subsidiary automatically. If the tax is pertaining to India. Is that clear?
Yes, yes, correct.
Even though income which are not in knowledge of the Indian company will also come up for consideration in the declaration made by the employer under section 192, I believe.
Right. Right. I think, Rajbhai, I think this is it.
Okay, I think it was a, Paresh bhai, it was a very elaborate presentation by you, and you have covered all the aspects.